We've got Rajat Jain, Chief Investment Officer, Principal, PNB AMC, joining us on the show right now. Rajat, hi, morning. Is my voice reaching you clearly?
Yeah, good morning.
Good morning, Rajat. Just wondering about what to
Hello.
do with PSBs, PSU banks, that is, and whether the correction is overdone there. Is it time to buy? And now with RBI sort of soothing the nerves as well, they've allowed banks to spread their previous 2 quarters MTM losses over 4 quarters. So that, in some sense, is also going to cushion profits. As it may just be an accounting entry, but optically, it's going to look a little better.
Sure. Yeah, actually 2 or 3 points there. Uh, First, on the RBI circular giving them leeway to sort of the losses they had in Q3 and Q4 to spread them over a period of 4 quarters. I think I think the larger banks, I think they had provisioned them so that they can potentially have a reversal of that what they had in Q3. So it is, yeah, in some ways going to help them, but then you got to create an investment fluctuation reserve, the 2% of uh, HFT and MTM. I mean, sorry, you got to AFS, you got to create an IFR, and which is actually tier 2 capital. So it's not as straightforward, but yes, it does have some help. But on the PSU banks overall, I think the issue really is that I think the larger PSU banks, I think they are as well run as anybody else. And so in our portfolio, for example, we do have the large PSU banks. But as you go down the PSU bank space, these banks are challenged in terms of capital, in terms of manpower, technology, all of that. So really, it's not about PSU versus non-PSU. It's really the better run bank versus a not so well run banks. So we do have PSU banks in our portfolio, but the large PSU banks are where our interests lie.
Rajat, IT, and that really has been the best hiding pocket. And we've seen the outperformance and resilience from the sector all of February as well as March too. Soon we're going to see some, earnings, and IT will be the first ones to deliver. What is it that you're expecting? While there will be that cross-currency tailwind that most IT majors would have, do you sense that the healthier performance would be from some of the mid-cap names?
Yeah, you're right. I mean, there will be a cross-currency tailwinds about 150 to 200 bips. I think you get on account of that. And but overall, I think I mean we expecting quarter-on-quarter growth. If you see somewhere around best about 2 to 2.5 to 3% QOQ constant currency sort of growth numbers. We do expect, yeah, the mid caps ITs have done well. I think, I mean, some of the arbitrage that they had, actually in some cases the mid cap ITs are slightly more expensive than the large cap IT names. Having said that, we expect over the medium term, that's next say 1.5 to 2 odd years, earnings to grow, I mean, on a yearly basis compounded about 8 to 10% per annum. I think that's what we expect. I think the kind of guidance we expect companies to give. I think the way the markets played it, because they were so much cheaper, they were after a tough last couple of years, they were seeing things bottoming out in their favor. The currency was helping. The fact that the US economy particularly was doing well. So all of that actually came together to help these IT companies, and I think the cheap valuation, they're still cheap compared to the market valuation. So I think there is some. So in our portfolios, what we have done is we were underweight IT for a fairly long time, but in the last, I think 2 to 3 quarters, we're still underweight, but we have cut our underweight position substantially in our portfolios.
Rajat, every fund manager has for the longest time maintained that buy into private banks. But now question marks have been raised on how some of the private banks are conducting themselves. And I looked at very simple data that last 5 years or even last 10 years ago, if you actually bought an ICICI bank or an Axis bank, you've not really managed to handsomely outperform the Nifty. So my limited point here is that, do you think one needs to be slightly more careful about buying private banks, and especially the banks which are corporate facing in nature?
Um, I mean, if you look at, so if in our portfolio, actually we divide our portfolio into financial space into three areas. So you have the NBFCs, you have the so-called corporate facing banks, and you have the retail facing banks. So we have had a retail facing bank, say about, very simply, about half our portfolio, 50-55%, and the rest would be between NBFCs and corporate facing banks together. And within the corporate facing banks, clearly the large private sector banks and the large we spoke about in the first question, about the large PSU banks, which we think are as well run as any private sector banks. Of course, they've had challenges because the kind of exposure they had to infrastructure lending, that they did for the last 4, 5 or 6 years, that's certainly come to hit them. But other than that, actually the large PSU banks are as well run as anybody else. So there have been some questions in probably one or two private sector banks, corporate facing banks as well. But I think if you look at, these are, we think, episodic, these are not, we believe, something that's going to kill the story, as it were. So we got to do our due diligence and buy the right corporate facing banks, either the private sector or the PSU space. One space that we have been slightly more cautious about is the NBFCs. We do have NBFCs in our portfolio, but however, we do see A, valuations obviously are expensive. B, they have, a lot of NBFCs have raised money, capital, so the capacity has increased in the sector, as it were, and there's increased competition, plus cost of borrowing is going up. So when when there's increased competition, I think we certainly see there could be some, I won't say wrong lending, but there could be some potential of aggressive lending there. So that is one space we are cautious about slightly in our portfolio.
Interesting is the way how some of these so-called brand companies are trading right now. Nestle is at a 52-week high, Britannia is at 5100.
So
Titan touched a 52-week high last week. So Rajat, I guess by now you must have guessed my question. Why are these stocks trading at such lofted P multiples? The concern in the market is centered around rich valuations. And if markets are selling off because valuations are stretched, then why are these stocks, stocks like Titan, Nestle, Jubilant FoodWorks making a new high on a daily basis?
So it's not for me to say the valuation is right or wrong, or they are, but our view clearly is probably markets, is fishing where it finds certainty. I think the market is in a mood in the last probably quarter or two, a quarter and a half certainly, when the volatility has come in the market. The markets wants to reward companies which we see certainty of earnings. We are not looking, or the market's not looking for, where earnings could be iffy, there could be speculation about numbers coming or not coming. So I say, okay, here we have the space where we certainly think rural consumption is going good, urban consumption is also reasonably holding up. Even the valuations are not cheap, but if we expect say 15 or 20% sort of earnings growth for the next few years, so I think let me be there. I'm not saying I agree with that approach, but I think that's where the market is sort of fishing.
Rajat, you have highlighted that there is some interest coming in within the two-wheeler pack. Four-wheelers are well explored, and I think among two-wheelers, it's really Eicher Motors which is over-invested. Do you think that the underperformers like Bajaj Auto, Hero MotoCorp, TVS Motors now have a reason to rise, given the recent sales numbers, plus the fact that data suggests rural demand is outpacing urban? We will touch base with Rajat in just a moment. But remember, it's really been a month where the two-wheelers have drawn a lot of interest. Yesterday, TVS Motors was up 6%. Bajaj Auto, if you could just revisit those rates again. Bajaj Auto up about 0.3%. TVS Motors also having had a decent run. Hero MotoCorp, the talking point, of course, is that FY18 was a great year for them in terms of the registered auto sales numbers. And one just adds in the story or connects it with the kind of demand revival we are seeing in the rural side of the economy. Sustainable or not, you're looking at these stocks pretty much under the radar, making their moves through the course of the last 3 months. We talk a lot more about the four-wheelers, but it's really two-wheelers where it seems like there is still an alpha opportunity therein. Is Rajat Jain back with us? Can we go across to him? Okay. But just want to open that discussion because there's so much talk about four-wheelers, there's so much talk about Maruti, M&M, Tata Motors also, their turnaround 2.0, but two-wheelers and this whole comeback in rural demand, you think is going to put them in a spot of their own?
The two-wheeler space is very interesting. We normally think that two-wheeler means motorcycles, but I guess the classification for two-wheelers has changed. You got TVS, which has made a very formidable comeback because they are riding high on the scooters or the so-called scooty. Hero, Bajaj never went into scooters, and they in a sense have suffered because they went towards exports, and exports took a knock because of whatever the regulatory challenges were there in some of the large markets like Nigeria and Sri Lanka. Then you had Eicher, which was a complete lifestyle bet, which was always this bet which the urban youth wanted because they wanted a better mode of transport. So the urban youth said, instead of just taking a car or Ubering it up, I'm happy to have this macho image of mine, and I'm happy to ride an Eicher bike. Hero MotoCorp was always a volume play because it gave you a play on penetration. It gave you this entire economy benefits for a commuter who always wanted to extract that extra mileage but was not very brand conscious, was only looking at more economy rather than an adaptable lifestyle or an aspirational ride. So the two-wheeler space really is split. My personal sense is that I think Eicher is going to struggle, and the stock is struggling, and the growth numbers are struggling. Bajaj for me is the dark horse, and the reason why Bajaj for me is the dark horse is why, because the export market almost has backfired for Bajaj Auto, and the export market is really capable of making a comeback. And frankly, if I look at the P multiple for Bajaj also, Aisha, I mean, it's an outstanding business. The stock of that kind of an outstanding business with operating profit margins which are well in teens should not trade at this kind of an P multiple. For Hero MotoCorp, I just feel that I don't know what are they trying to target. They're trying to target the actual rural consumer, but that brand recall which Hero MotoCorp gave me 5, 7, 10 years ago,
that's a miss.
That's a miss.
Yeah. In fact, Rajat, you want to take that point forward on two-wheelers, if you got my question there previously?
I think that's the point I was making, and just before I think we got disconnected. I think rural consumption is clearly, anecdotally talking to businessmen, is that it's really holding up. And so I think, yes, two-wheelers, so I think there are well-run companies, the company that you mentioned, for example, and they are, I think, well-run, reasonably valued companies. So I think, yes, they actually should do well, and which is why we have some of them in our portfolio.
Rajat, where are you looking at increasing your exposure? Right now, we've seen a sell-off in mid and small cap stocks. Large cap stocks also have corrected. So where are you happy to use the current decline to your advantage to increase your exposure? I mean, what are the areas where markets currently are nervous, but you think the value has emerged and you want to be a contra buyer?
You see, our portfolio overall is, I think, positioned long the domestic cyclical story. So we are long, for example, autos, including, I said, two-wheelers, four-wheelers, auto ancillaries. We are long cement. We have cut underweight in the IT space. I think, and also what's happened in mid-cap space selectively, as some of them have taken quite a bit of a pasting and are more reasonably valued. So I think over the next, say, not in the near term, I think near term probably large caps still do well when there's an environment of flight to safety, which is why you see these consumer stocks trading the way they are. So, but over the next 2 to 3 years, I think mid caps still should do better than large caps. So, and we find them reasonably well run companies available, not this crazy valuation. So we have added some of those to our portfolio as well. But wholesale, I mean, we really haven't made any wholesale changes to our portfolio. We still remain positioned the way we were in the last quarter.
Okay. The other theme is oil and gas, Rajat. Are you looking at how crude oil prices rising would impact ONGC? There's all that talk about OMC's margins coming under pressure because there might be a bit of a political overhang over here with them managing their business. Nobody's talking about a complete rollout of the deregulation regime, but there could be a bit of an influence there ahead of the all-important election season ahead.
Yeah, so in the OMC space and broad energy space, we really have select oil marketing companies, I think, but overall we did cut down our exposure there simply because we did see oil prices rise, and we have we had them for a while. We have played the story, so we are not so aggressive in that space at this point of time. We like the gas space, so we have been in the gas space, but OMC is actually something that we have cut our exposure to.
Speaking with you, thanks so much for taking the time out and sharing with us your investment theme and what you're making of the market and the various sectors right now.